Hello friends, good evening to all of you, and today we are going to start with the next module of the CAIIB BFM. The complete course for the CAIIB is available, and it's the first chapter from the module C that's related to Introduction to the Treasury Management. Now we are going to learn each and everything about it. So do confirm the audio video quality at the earliest so that we can proceed the video. You can be watching the video on the YouTube as well, and also available through the application for now. But later on, the videos will be available just on the application. So do download the application. It is available at this link, iibf.info/app. So the audio video quality is working all fine. So let's start the session at the earliest. So it's related to the treasury management. Now, what is treasury management? So it's strategic management of the bank funds, banks liquidity, banks investments, about the foreign exchange operations and the financial risk, each and everything. So whether we are talking about managing of the CRR ratios or profit maximization or risk management, or about the ALM regulatory compliance for the CRR SLR purposes, for the capital protection, it's the duty of the treasury department. It's a duty of the treasury department. So the first function that we're going to learn about for the treasury, it is what? It is related to liquidity management. The treasury as a liquidity management, right? So treasury basically does manage the funds. So whatsoever your funds that you are going to receive over the time horizon, let's say we are taking the time period of 3 months, and over the time period of 3 months, time horizon of 3 months, you are going to receive 500 crores, and over the time of 3 months, you have to pay off 550 crore. Now the cash outflow is more. The cash outflow is greater than that of the cash inflow. So that will be related to that we are to manage the fund gaps. We are to manage the fund gaps. So that's about the liquidity management. So initially what was there about the treasury department, that it was to manage the funds, such as so as to manage the cash balances, so as to deploy the surplus funds, and also to source the funds. That was the main purpose related to the treasury department previously, right? Like I told you that the cash outflow is greater than the cash inflow. So in that scenario, there is a gap is existing, which is the fund gap. Now this fund gap is basically negative in this case, like the cash outflow is more. So whatsoever the gaps are there, those are to be bridged, right? So that was the function about the treasury. But now the treasury is responsible for the various things, like I told you, ALM, risk management, and so on. But in banking, the treasury is also responsible so as to manage the reserve requirements. Now the banks are to comply with the different rules and laws, like the banks are to manage the cash reserve ratio, the banks are to manage the statutory liquidity ratio. So it's a duty of the bank so as to manage those regulatory compliance functions, right? So that's a duty of the treasury. Means in the bank, it would be the duty of the treasury so as to manage the CRR balances, so as to manage the SLR balances. Clear with it, right? And further, it's also about investment. Now what's of the surplus funds, those are to be deployed, like the excess funds are to be deployed in the SLR securities, and those can also be deployed to the other different sectors from where the bank can be getting much more profits, right? So that's the point related to it. So treasury, initially, if we talk about the treasury, it was just about the liquidity management. But now from the organization point of view, now it is considered as a service center previously, but now it is also considered as profit center. But now it is also a profit center. You can be making profit out of it, right? So the treasury is going to connect the activity of the bank with the financial markets, and also it plays a very important role for the ALM, for the asset liability management purposes. It basically is very much it plays a very much important role. Clear? Now after that, it's about the integrated treasury. The next topic that we are going to learn about the integrated treasury, and then further we are going to learn about the different distinct roles which are being played by the treasury. No, what do you mean by integrated treasury? It's about the integration of the different markets, like financial market, money market, securities market. So it's like integration of the same. So integrated treasury basically refers to the treasury structure, like where the different markets, like the securities market activities, foreign exchange transactions, and the money market operations, those are all managed under a unified system. So there will be no separate system for each and every market, but there will be a unified function for the same. And also the integrated market, or integrated, not market, integrated treasury basically enables that we can be optimizing our profitability, we can be optimizing our liquidity requirements, we can be managing the financial risk much better way and much more effectively, right? So what was the major origin related to the integrated market? What was a major reason that we moved toward the integrated market? Because it was a let's say a result of the financial sector reforms in India. So there were financial sector reforms, important reforms were there, due to which there was basically a liberalization of the financial markets. The interest rate was deregulated, that the banks were basically having their own freedom so as to determine their lending rates, so as to determine their deposit rates. So the deregulation of the interest rates was there. That was an important event. And also the partial convertibility of the rupees there. Like there is allowed to a greater extent that we can be investing into the foreign exchange transactions, or the cross border transactions are allowed in multi folds now. Now these reforms basically increase the interaction between the domestic market with the international financial market. So there was a requirement related to the integrated integration of the operations to be done, right? Now let's learn about the convertibility of the rupee. Now if we're talking about the Indian rupee, it is fully convertible on the extent of the current account transactions, like for day-to-day transactions, like for trade transactions, business transactions, like if you want to send money for medical purposes, for education purposes and all, those all transactions are covered under the current account transactions. And for current account transaction, Indian rupee is fully convertible. And also for capital account transactions, it is convertible but partially convertible. We can say it's allowed for the capital account transactions, but for basically, let's say partially it is allowed, like whatsoever the transactions are allowed for FDI purposes, or through the ECB, that is external commercial borrowings, or ODI, overseas direct investments. So that's basically allowed through those, right? And further after that, it's about the larger limits are now being available with the banks. Now banks are permitted that they can be undertaking the overseas borrowing, like they can be doing borrowing abroad, they can be investing money abroad, right? So that's basically like they have the freedom related to it. Now the banks are having the access to the foreign currency funds, and those funds are also available at the competitive rate. Now you are having the diversification related to your investments, because you are having the opportunities globally, where you're not just investing the money in Indian markets, but you're also investing money in the foreign market. So that's basically a huge difference that's now available, right? And also you are having the improved liquidity management now. So that's the basic another point related to it. And also if you're talking about sources of the funds, now the banks are having the different sources. Now banks are having the different sources of the funds. The banks are getting the foreign currency from the NRI deposit, from the EFC accounts, from the let's say ECB balances, or let's say line of credit, or let's say offshore operations. You are having balances with you. Now you are having adequate foreign currency liquidity with you, right? So that basically allows you that you can be investing between the different currencies. And now, because there is full convertibility and integrated cash flow management is there, so there is no difference between Indian rupee and the foreign currency now. Because earlier banks were to maintain separate management system, but now there is integrated treasury. Now that need related to that, you are to manage the foreign currency position differently. That is eliminated because there is unified cash flow system now. There is unified integrated cash flow system now. And also there is flexibility in the fund management. There is a flexibility related to the fund management, because the integrated treasury does allow that the banks can be transferring the funds across the markets, across the currencies without any restrictions. Like you can be investing the long-term funds into the short-term investments, and also the securities market to the money market. Like you are taking money from the securities market, investing into the money market, or let's say you are converting the funds from one currency to another currency. That's basically totally allowed. Total flexibility is now available with the banks. Clear? And also integrated treasury is in a position that you can do the cross market operations. You can be doing the cross market operations. You can be investing into the currency market, into the derivative market, into the forex market. So that's basically allowed to you. That's basically allowed to you. So now what are the functions which are there with the integrated market? Different functions, important functions are there. Like first function, which was a like traditional one, it's related to the meeting up with the reserve requirements of the cash reserve ratio and the statutory liquidity ratio, and the global cash management is to be done. So now the cash management is not to be done for just Indian rupee, but it is to be done globally for the integrated cash flow management purposes, right? And also it does provide the efficient merchant services, foreign exchange advisory services. Those are also being provided by the treasury, and they can be optimize the profits by exploiting the new opportunities, because the multiple opportunities are available across the globe. So we can be exploiting those markets so as to have such profit havens with us. And the risk management can be done in proper manner because it deals with the ALM. So that's also a function which is performed by the integrated market. Clear with it? Clear with it so far? Please do confirm at the earliest that if you have understood this particular topic so far. Now, after that, we have to learn about the three distinct roles of the treasury. Very important topic. It's about the three distinct roles of the treasury. The first role, it's about the liquidity management. The first one, the important one, it's about the liquidity management. Like it's basically the traditional one, like, and it's also the fundamental. So we can simply say this role is a traditional role, and also this is a fundamental role which is played upon by the treasury, right? So the treasury is to ensure that the bank is having the adequate funds, so that whatsoever our operational requirements are there, regulatory obligations are there, we could be able to meet them upon, right? That's a first responsibility related to the treasury. That's a liquidity management. So whether it's about the short-term liquidity funds, or it's about the cash flow monitoring or CRR SLR compliance, that is to be done, right? And it ensures particularly that the proper smooth functioning related to the bank operations and financial stability is there within the bank, right? The second important role which is played by the treasury, it's about the proprietary positions. Now, as I told you that previously it was considered as a service center. It was considered previously as a service center, but now it is also considered as a profit center, right? Now it can take the proprietary position. Proprietary position means buying and selling the financial instruments using the bank's own funds so as to generate the profit. So it's not like that you're taking the position for your customer or for the corporate, for the individuals. No, you're taking the position, you're taking the exposure for your own benefit, like we individuals do. Like if you're having money, surplus money with you, you are deploying the funds in the different markets so as to make profit out of it. Now that particular thing is done by the treasury also. That's a proprietary position. So they can be taking the position into the derivatives, into the government securities, in the corporate bonds, in the foreign currencies. That can be done, right? So as to earn the trading profit, so as to basically earn the capital gain out of it, or the arbitrage income, right? And the third one, the important one, it's about the risk management. Now risk management is what? So as to hedge our risk. So first of all, the treasury is to do identification of the risk. Identification, quantification, monitoring and control and mitigation of the risk is to be done. And it is done through the ALM, through the asset liability mismatch management, right? So if there asset liability mismatch and if that gap is filled, that gap is bridged, so you can do the management, and that way you can be managing the risk. And also you can be providing the proprietary risk management, like whatsoever the proprietary positions you are taking, right? So you can be investing into the different instruments so as to hedge your own risk for the financial stability and for so as for the balance sheet strength. That can be done, right? So these are the main roles which are played by the treasury. Different three distinct roles played by the treasury. Very important topic, right? So if I've learned so far from this video, and if I've liked this particular content so far, make sure so as to subscribe to the channel at the earliest if you have not subscribed, and also press the bell notification icon so that you get updated whenever we upload the new video. And make sure so as to like this video and share this video with your friends and colleagues. And if you want the PDF of this particular file, you just need to WhatsApp writing CAIIB. Just simply do write CAIIB and WhatsApp it to the number 83609 44207, and I'll be sharing all the details with you. Right now, after that, let's move toward the another topic. It's about the multiple roles of the treasury. It's about the multiple roles of the treasury, right? So first one, it's about the ALM book management. It is about the ALM book management. Now, what is ALM book? This is asset liability management book. So it's basically the ALM book deals with what? It deals with the internal balance sheet management. It deals with the internal risk management, or we can say internal balance sheet management. It deals with, and it focuses on controlling the interest rate risk. So we are to focus upon those so that we can control the interest rate risk, liquidity risk, maturity mismatches. So it is for internal risk management first of all, right? And it manages the liquidity gaps or the interest rate exposures. And this is a traditional function. So let me write over here. This is the traditional function which is performed by the bank. And the second one, it's about the merchant book. Merchant book basically relates to the client driven transactions. It basically is related to the client basically driven transactions. Like when we are talking about our own position, it was about the proprietary positions, right? That basically is the trading book. But when we are talking about the merchant book, it means whatsoever the exposure we have taken on behalf of the client, right? It could be related to foreign transactions, it could be related to advisory services or the derivative products, it could be anything. The third one, it's about the trading book. It means the proprietary positions that are taken for the bank's own purposes. We have to manage those things. We have to manage those things. Like you have taken the position in the forex market, money market, securities market, derivative market, so as to maximize your trade profit while managing the market risk, right? And further, it's about the process of globalization. Now, what is globalization? Globalization means interaction or integration between the domestic market and the global market. That is said to be the globalization. And when we are talking about the market, we are talking about the financial markets, right? So it's basically increased interaction between the countries, like because the free movement of goods is there, service is there, capital is there, financial investment is there. That is the main fundamentality to the globalization. And why globalization is there? Because there is free flow of the capital. First one, free flow of the capital, and the cross border financial investments are being done. The cross border financial transactions and deregulation. Like I told you that the current account transactions are fully convertible and the capital account transactions are partially convertible. So capital flows from one country to another, and there is increased international trade and the investment, right? So there is export and import, there are remittance being done by the individuals and the companies, there are foreign investments and the borrowings being done. So these are the miscellaneous remittances or the transactions, and due to which the cash flow is there. Now, that may be due to the FDI or that may be due to the FII. FDI is foreign direct investment and FII is a foreign institutional investment, right? We have already learned about the difference between FDI and FII before, so I'm not going to explain it again. And further, it's about the fund flow on the capital account. Now, capital account is just, let me just first of all tell you about the capital account transaction. Let's say you are here residing in India and you're going to do a transaction which is going to alter your asset or liability or contingent liability in other country. That is a capital account transaction. Let's say if you have taken a ECB from other country, it would be a capital account transaction. And on the other hand, if the NRI in the other country does a transaction in India that is going to alter its asset liability or contingent liability here in India, that will also be the capital account transactions. And that could be due to the different like purposes for the different routes, right? So it could be related to the portfolio investment. Like if you have done the equity investment or the debt investment, that will be basically what? That will be the capital account transaction. And it could also be related to the direct investment, like the foreign companies, foreign institutional investors. Basically, they have invested for the long term in the domestic country, in the new projects, in the manufacturing facilities. That is also the capital account transaction, and it is also related to the ECB, that is the external commercial borrowing. Like let's say it is through the automatic route allowed for 750 million USD, 750 million USD per financial year through the automatic route, that you can avail the external commercial borrowing, right? And now that will be what? That is also amounting to the capital account transaction, right? And also if the equity or debt instruments are being issued in the global market, right, that is being issued, that is also the capital account transaction. And also it's related to the mergers and the acquisitions. It's about the mergers and acquisition. Let's say capital flows through the cross-border mergers and acquisitions, like foreign companies acquiring the domestic firms, or domestic companies acquiring the foreign businesses, or there is a strategic partnership between the international corporations. These are basically there so as to promote the business expansion and the global integration. But that is also amounting to the capital account transaction. And also it could be related to payment for the technology transfer or royalty, or something like royalty payment is being done. IPR, it could be intellectual property rights, or financial and consulting services are being done, right? So if the knowledge transfer is there, technological advancement is there, right? There is payment for the same, that is also amounting to the capital account transactions. That is also amounting to the capital account transactions. So these are the different routes for the capital account transactions. So it's related to the fund flow on capital account. Fund flow on the capital account. Clear with it? Do confirm. And what would be the impact of the fund flow or the capital flow? What will be the impact related to the capital flow that we are to learn in the next topic? So what will be the impact? Now, when the capital is flowing from one country to another, it's going to impact what? It's going to first of all impact the money supply of that particular country. And if money supply is altered, definitely the interest rate will also be altered. Like money supply is what? Let's say country A, investor in the country A have invested heavily in the country B. Now the money supply in the country B will be increasing. The capital inflow will be increasing. The liquidity in the country B will be increasing. When the increased liquidity is there, large inflow is there, the interest rates are going to be reduced. The interest rate in this country B, they are going to be reduced. And further, if the outflow is there in country A from where the money is moving out, the interest rate here will be increasing. So there is impact when the capital is going to flow. And also the exchange rates are basically, like, they also become volatile, because the outflow is going to weaken the currency of that particular country. Now, if the A country is having the currency of JPY, then the JPY value will be reduced. And for the B's current country currency, let's say it is euro, then euro will basically become more stronger. It will be having the appreciation. So the country in which the inflow is there the exchange rate will be appreciated, and country from where the outflow is there the currency will be depreciated, right? And also it's going to change the BOP. It's going to change the BOP, that is balance of payments. Now capital inflow influences the capital account and overall BOP positions also, right? And second thing, it's about the risk associated. Because let me just tell you, the whensoever the inflow is there, it's going to support the economic development, but also it may lead to the financial instability due to the volatility. So there will be the volatility that will be existing. So the volatility will be existing. Why volatility? Let's say 10,000 crores or 1 lakh crore are invested in one country. Now it's basically going to impact the money supply that particular country. And let's say if it is withdrawn, like suddenly abrupt withdrawal was there, what will happen? Now the sudden movement in the portfolio investment will lead to what? It will lead to the instability of the financial market of the said country. So let's say 1 lakh crore were invested into the stock market. It may crash, or it may basically increase the stock prices, which we say to be pump and dumps purposes, right? So it is done. And interest rate will also become volatile. The exchange rate will basically, those are going to fluctuate very sharply. Now that's basically going to increase the investment risk. The financial fluctuations will increase. The uncertainty will increase, right? And also It's related to the systemic risk. Now, what is systemic risk? Systemic risk is like if the one institution is going to fail, the another are also going to fail. They can be the cascading of the different events, right? So the global financial integration exposes the domestic economy to the systemic risk, because previously the domestic economy was not related to the global economy, but now integration is there. Let's say one bigger player, global player, is down, the other will also become down. There will be negative impact on the others also, because there is integration of the domestic market with the global market, right? Now, let's have a look at the role of the Reserve Bank of India in the capital flow management. What is the role of the Reserve Bank of India in this case? Now, definitely very important role is being played, because RBI is giving the regulations and also it basically facilitate the international capital flows related to it, right? So, RBI does allow through the automatic route or by delegation of the powers. So it could be through the automatic route or by the delegation of the authority, so that the power is basically given to the authorized dealers, which will be allowing that this much capital inflow can be there, this much capital outflow can be there. So there is delegation of power, like a power is given to an officer scale 1, that you can be sanctioning a loan up to rupees 20 lakh, not above that. So the loan will be sanctioned up to rupees 20 lakh only by the officer scale 1. So if the higher loan is to be sanctioned or disbursed, the permission is from the upper scale is to be taken, right? So that's about it. So first of all, it's about the FEMA. The first regulation that is given by the FEMA, that is FEMA 1999, that is Foreign Exchange Management Act. Now it replaced the FERA. Previously it was the Regulation Act, but now it is the Management Act, which came in 1999 and was operable from 2000. So first of all, if we talk about the FEMA is management, but FERA was related to strict regulation. And FEMA is to basically facilitate the external trade. It basically facilitates the external trade, whereas the FERA was related to conservation of the foreign exchange. FERA was basically concerned about that we are to conserve the forex with us, but FEMA is about that we are to facilitate the forex exchange. We are to facilitate the external trade, right? And if we talk about the FEMA, it is liberal, it is facilitative, but the FERA was restrictive. It was control oriented. So FEMA basically is market friendly foreign exchange regime, we can say. It is market friendly. FEMA is market friendly and foreign exchange regime. And further, the renaming was done, like the exchange control department, which was there, it was renamed to the foreign exchange department. Previously, it was ECD, exchange control department, but now it is FED, that is foreign exchange department, right? And further, it was basically previously it was control based regulation, but now it is management related to the exchange transactions. And further, it's about the liberalization of the current account transactions. Now the current account transactions are fully convertible. That is basically largely liberalized. So if you are doing the transactions related to import, export, let's say trade transactions, or we are to do the transactions for donation purposes, medical expenses, remittances purposes, there is like without any approval, you can do such transactions subject to the limits under the foreign exchange. Like for individuals, the limit is given by under the LRS, liberalized remittance scheme. What is the limit? It is USD 2,50,000 per financial year. This is the limit. This is the limit. And after that, it's about the convertibility. Now, the capital account convertibility is partial, but the current account transactions are fully convertible, right? Then the next topic, it's about the impact of the globalization. And when we're talking about the impact of the globalization, it is threefold impact. The first impact is there on the interest rates. The first impact is there on the interest rates, because when we are integrated to the global market, definitely the global financial conditions are going to impact the domestic interest rates, right? Because if global cash inflow is there in the domestic market, it's going to impact your interest rate. If the global interest rates are basically increasing or decreasing, those are basically going to impact the borrowing cost or borrowing rate here in India. And also if the exchange rate movement is there, definitely it's going to impact the capital movement of the international market in India or out of India. So definitely the interest rate impact is there. That's the first impact. The second impact, it's related to the new institutional structure is there. It's related to the new institutional structure is being developed here in India, and there is establishment of the modern financial and market infrastructure is there. The new regulatory institutions are there, like SEBI is there, Securities and Exchange Board of India is there, which basically regulates the capital market. And other than that, we are having IRDAI. What is IRDAI? It is what is IRDAI? Anyone full form related to it? Insurance and Regulatory Development Authority of India. Insurance Regulatory Development Authority of India. That is IRDAI. Clear with it? And further, we are having the other institutions, like we are having the CCIL, Clearing Corporation of India Limited, like which governs the settlement of the government securities or the foreign exchange transactions. We are having the NSDL, National Securities Depository Corporation Limited, like it deals with the electronic holding and transfer of the securities. CIBIL is there, which is a credit information company, right? And the credit rating agencies are there. Now CIBIL is CIC. CIBIL is CIC. It is CIC, that is credit information company. And we are having the ICRA, S&P and other institutions. Now in India, ICRA is there. S&P is international organization, and these are credit rating agencies. These are said to be CRA. These are credit rating agencies. Now, these institutions basically strengthen the transparency, market transparency. These do strengthen the risk management and the financial stability here in India, right? So that's the second fold. And the third fold of the globalization, the impact we are talking about, it's about the product range. It is about the product range. Now, you're having the expansion of the product range in treasury. Previously, you were dealing with the like liquidity management and all, but now it's about the usage in different products. RBI has basically allowed the multiple rupee derivatives, which does enable the banks and the corporations so as to manage the financial risk more effectively. Like we are dealing in the forward contracts now, the currency swaps are available, forward contracts are available, the interest rate options are available, interest rate swaps are available, the options are otherwise available. Now these products are basically used for hedging, for safeguarding ourselves, for the trading purposes. Now these derivative instruments are used for hedging purposes, for trading purposes, and also for the profit generation purposes. For the different purposes, these are being used. Clear with it? Do confirm. Have you understood it so far? Right. The next topic we are going to learn about, it's about evolving role of the treasury. Because I told you that previous role of the treasury was related to what? It was related to the service center. But now, it is evolving as a profit center also. So there is evolving role of the treasury as a profit center, right? Now the treasury is very much favorable, and it is basically very much attractive. It is becoming very much attractive. Why? Because first reason is related to the operations in interbank market. It's related to, it does operate in interbank markets, like the treasury transactions which are there, those are going to occur in interbank markets, like where the credit risk is minimal. Because when you are dealing with bank to bank purposes, the credit risk is very much low, but when you are lending to the customers, the credit risk is higher. So very limited capitalization or capital allocation is to be done. So the capital allocation is low. So the capital allocation is low, right? And the second thing, it's about the highly leveraged. Means you do require just 2 to 5% of the margin. Margin money is just required. And of what quantum of 2 to 5% so as to participate in the transaction. And the return is quite higher. And also the operational cost is very low. The operational cost is very low, right? Because lower resources are required when we compare it to the retail banking or wholesale bank. This is why the treasury is shifting its image from the service center to the profit center. From the service center to the profit center, the image is now changed, right? And then it's related to the sources of the treasury, like profit sources of the treasury. Now, there are some conventional sources which we are going to learn about first of all. And also, there are the contemporary sources of the treasury profits. First, when we are going to learn about the conventional sources, it's about the foreign exchange business. Like foreign exchange dealings form a major component of the treasury income, right? So bank is going to earn the profit through the spread between buying and selling. Let's say we are going to buy the currency and further we are going to sell the currency, or let's say we are going to sell the currency and we are going to basically buy the currency. So these can be the cases. These could be the cases, and whatsoever the spread that we are going to earn in between, that basically makes the most of the profit for the treasury, right? So spread is what? Spread is the difference between the buying rate and the selling rate, right? So when we are buying forex, the bank purchases a foreign currency from the exporters. When we are selling the forex, the bank is going to sell the foreign currency to the importers, right? So here the bank is going to earn the fee-based income, or the trading income for the bank is there. The second one, it's about the money market deals. It's about the money market deals. So bank can be basically be using the treasury so as to manage the short-term liquidity by lending the surplus funds. Now, whatsoever the surplus funds with the bank is there, the bank can be lending it for the short-term purposes in the money market and can be earning the interest. Like in the case of call money, the money is lent to the other banks for the overnight basis. Under the notice money, for the call money, it is for overnight basis. For notice money, it is for 2 days to 14 days. And further for term money, it is greater than 15 days and up to 1 year. And up to 1 year. The money will basically is going to be interbank. So lesser capital is to be allocated because in case of the interbank transactions, the credit risk is very much low, right? And the third one, it's about the investment activity. It's about the investment activity. Like the banks can be investing into the government securities, in the corporate bonds, and the strategic investment can be there, like investment in the subsidiaries or the associate companies. That's basically the strategic investment, right? So the bank can be investing in the government securities, like so as to satisfy the SLR requirements, and also the non-government securities like corporate bonds, and also the strategic investment can be done by the banks, right? So these are what? These are the conventional sources of treasury profit. The another one, it's about the contemporary sources. Contemporary sources. The first one, it's about the interest arbitrage. Interest arbitrage means, let's say the treasury is dealing in multiple markets, M1 and M2. The treasury is going to, let's say, borrow the funds from one market and is going to lend the funds in another market and is going to earn the interest rate, and that is being done simultaneously. So that is what? That is a interest arbitrage that the bank is going to earn. Or the it's not just about the borrowing or lending, but it's also about that the banks treasuries are going to exploit the interest rate differences between the markets or the currencies, right? So whatsoever the borrowing rate is there, lending rate is there, the difference between the same is going to the profit for the bank. So that's the first contemporary source of profit for the banks. That's the interest arbitrage. The second one, it's about the trading. It's about the trading activity. Like you're going to do the speculative buying and selling of the financial instruments. Like if we look at the chart and we do know that the prices might go above because that's our speculation. So they can be doing the currency trading, they can be dealing in the government securities and the bonds in the derivative markets, so as to do take up the speculative positions. Now if the favorable price movement is there, definitely there is going to be profit. Definitely it's going to be their profit. And also the banks are allowed, the banks who are holding the authorized dealer licenses by the Reserve Bank of India, they are permitted that they can be trading in currencies within the preset of the limits. That's basically allowed. And treasury may go long. May go long means buying the currency, may go short means selling the currency. So the banks can be attaining the long position or the short position. The long position means that you are having the you are buying the currency, and short position means that you are going to sell the currency. So that can also be done. So the banks can be having the open position so as to make the profit. So the speculation can also be the part. The bank can also be having the proprietary positions in case that is said to be trading. The third one, it's about the treasury products. The treasury products which are being, let's say, given to the corporate customers, and these products are going to help the corporate customers so as to hedge their interest rate risk or the currency risk. Now these could be the FRA, like the forward rate agreement, or these could be the forward contracts, or the interest rate swaps, or the currency forwards, or the options which are offered to the corporates, and the banks are going to earn the fee based income, or the bank is going to earn the commission or the fee based income upon it. Clear with it? Now after that, it's about the organization of the treasury. It's about the organization of the treasury. So treasury is basically structured as a specialized operational unit within the bank. So it's a specialized operational unit. So it's like a department of the bank or the operational unit of the bank, or further it could be also be a specialized branch under the direct control of the bank's head office. It could be working as anything. Like it can be working as a particular department of the bank, like as a department, like any other department, like the credit department or HRD department. It could be a department which is working within the bank, or it could also be a specialized branch under the head office, right? Now, what are the advantages? What are the advantages related, let's say, if it is following the specialized branch structure? And the most banks do prefer the specialized branch structure. Why? Because the independent accounting is there, first of all. So when the banks are following the specialized branch structure, there is independent accounting. So you are managing your own profit. You are managing your own profit and loss account. You are having the general ledger accounts. And for the, you can be participating in the market directly. So the direct participation. Second benefit is you can directly be participating into the market in the clearing and settlement systems. And further, you can be conducting the foreign exchange transactions directly. You'll be having the authorized dealer status. You'll be having the authorized dealer status. So these are the three benefits. Those will be available if you are basically having the treasury as a specialized branch, right? And why it is preferred? Because first of all, you're having the independent accounting. Second thing, you'll be having your own profit and loss account and the general ledger accounts. Clear with it? So you'll be having the independent accounting, you'll be having the direct market participation, and you'll be having the authorized dealer status. You'll be having the authorized dealer status. And the treasury is basically headed by a senior management person. It is being headed by a senior management person, which will be a general manager, or let's say a CTO, that is Chief Treasury Officer, or Vice President Treasury, right? So it is headed by a senior management person. Clear with it? Further, let's have a look at the divisions of treasury. Divisions of treasury. So it's basically divided into three parts. It is basically the dealing room or the front office, like which basically conducts the trading and the market transactions. That's the front office. Or it could be the mid office that does the part related to the risk management, monitoring limits. So it does the risk management, or let's say so as to monitor the limits, right? Or does deal with the compliance purposes, right? And also it could be the back office. The third component is the back office, and it is a treasury administrations, like what's of the transactions which are done by the front office, because front office like the branch which is going to deal with the customers, right? So what's of the transactions which are being conducted or being done by the front office, so as to check those transactions, so as to reconcile the transactions, so as to done the documentation for the same, right? So those all things are being done by the back office, right? So this segregation basically ensure the operational control, transparency, and effective risk management. And the effective risk management, right? So the treasury administration is related to the back office. The front office does the transactions and mid office is related to the risk management purposes. Clear with it so far? Do confirm. Let's have a look at these particular offices. First one, it's about the dealing room or the front office. So we're going to learn about these three departments now in detail. The front office, back office, and the mid office. Very important topic. Very, very important topic. So the dealing room is said to be what? It is said to be the front office, right? And further, it is the operational center. This is the operational center because it is going to deal with the customers. So the market transactions are executed here, and here we are having the chief dealer. Here we are having the chief dealer who will be the head of the front office, right? That is going to head the dealing room and is in charge of the front office. And there are other dealers also which are working under the chief dealer, which are going to basically transact, which are going to do the transactions. And definitely the dealers are specialized in their own field in the different markets. Let's say one dealer is related to the foreign exchange, money market or securities market, right? And also they can be related to integrated market. But let's say the dealers are generally familiar with all the markets, but in general they will be specialized in their own like cadre. Like one dealer is associated with the money market, the other is dealing with the foreign exchange market or something like that. So we'll be having the multiple dealers, right? And further, securities market is normally divided into two parts. When we're talking about the securities market, like we are talking about where the market equity or shares are being sold or purchased, it's divided into two parts. One, it is in the primary market where we deal with the IPOs or FPOs, right? And one another, it's related to secondary market. One, it's related to secondary market. And the securities dealer is going to mainly deal with what? They are not going to deal with the primary market. They do deal with the secondary market only, because it's about the buying and selling the securities where the securities are already available in the market. Why the primary market is not being dealt with it? Why the primary market activities are not being done by it, by the front office? Because there is involvement of another risk, another level of risk may be there, because proper credit assessment is to be done, the examination of the issuing term is to be taken care of, and also the regulatory compliance is to be looked into on the part of the primary market. So when we are talking about the securities market, we are dealing with the secondary market and not with the primary market. The primary market is being dealt by the investment department. That's another department out of the purview of the dealing room, out of the purview of the dealing room, right? So that's about it. That is about the front office. The second office that we are going to learn about, that's about the back office. Now, what are the administrative and the settlement functions? Those are being performed by the back office. So we can say it's about the administrative and the settlement functions. And settlement functions. These are performed by the back office, right? So it is basically the control mechanism. So we have to ensure the verification. It is going to ensure the verification and settlement of the transactions which are conducted by the front office. So it is going to do the deal verifications. The first one, it's going to do the deal verification, that verifying the transactions which are executed by the dealers. And also it's going to do the confirmation from the counterparties. So the confirmation from the counterparties is to be taken, and also the deals are to be verified independently. That is to be done, and also it's going to take care of the bookkeeping and the submission of the periodical returns to the to the Reserve Bank of India. Whatsoever the returns are to be submitted to the Reserve Bank of India, that is to be done, right? So the deal verification is to be taken care of, and also it is going to manage a different type of account, like the treasury accounts are being managed by it, like the nostro account is being managed by the back office, the RBI funding account, and that is to be managed, and let's say securities account, the demat account, and everything is to be managed. And also it is to ensure that the adequate margin money is held with the CCIL. Adequate margin money is basically held with the CCIL for the different settlement purposes, right? And there is a key function which is performed by the back office, that is a settlement function. That is a settlement function, that all the payments and receipts must occur on the value date. on the value date as agreed settlement date of the transaction. So all the transactions must be settled on the value date. That's a key function which is performed by the back office. Why? Because if the transactions are not occurring on the value date, then there will be the financial loss. There can be the settlement failure, and also the reputation risk will be there, right? So if these things are not dealt with properly, what things will be there? The financial loss will be there, and also the settlement failure will be there. The settlement failure will be there, and reputation risk will be imposed. Reputation risk is imposed, right? So it is very much key function which is performed by the back office. And then it's about the third office, that's a middle office. So middle office is responsible for the risk management. Primarily, it's responsible for the risk management purposes, for monitoring, and one another function, that is reporting. Reporting to RBI, not reporting, but returns to RBI are to be filed by back office, but reporting to the higher management, that is being done by the middle office. So it basically is independent unit. It is like an independent unit, right? And also it is going to act between the front office and the back office so as to ensure the control and compliance, right? So middle office is just acting a control function and the compliance function between the front office and the back office, and it is having the multiple functions. Like it is doing one function as the MIS, that is the management information system function. It is basically played by the middle office, like providing the performance and risk reports to the management. Like reporting is being done by the middle office, that's the first function. And also it's going to monitor the exposure. So we can say so as to monitor exposure, that is being done by it. And also it take care of the stop loss limits, SL limits, stop loss limits, that the front office is not missing the uh, stop loss limits. And also it is to do the risk analysis. The risk analysis is also to be done by the middle office. So middle office is going to ensure that the treasury activities are being done as per the approved risk parameters, as per the approved risk parameters, right? And also the transfer pricing is being managed by it. What is transfer pricing? Like transfer pricing is going to determine the internal pricing of the funds. Let's say the credit department is to sanction a foreign currency loan to the borrower. Foreign currency loan to the borrower. Now the foreign currency will be available at what rate? That pricing will be done by the middle office. So the transfer pricing mechanism will also be implemented through the mid office, right? And also in smaller banks, middle office function also plays a function related to the ALM support group. Middle office itself plays a function of the ALM support group in case of the small banks. Now, what is ALM support role? ALM support role is like monitoring the maturity gaps, managing the interest rate risk, like monitoring the liquidity risk, right? And then it's about the ID, that's out of the purview of the dealing room. That's the ID, that is the investment department. Like when we are to invest into the primary markets, in IPO, in FPO, right? So let's say when a suitable offer is received, the department would be analyzing that if this proposal is acceptable or not, right? They will be evaluating the investment proposal, they will be conducting the risk and the financial analysis, they will be further be submitting the proposal for the appropriate authorities so as for the approval purposes. And there are other departments also, like we are having the accounting and administration department. Accounting and administration department, that's going to manage the treasury accounting and administration. And system administration department is there, like which is going to manage the treasury technology systems. And the remittance department is there, like which is going to handle the payment systems like Swift or RTGS or NEFT. Those are to be handled by it. Okay, so that was all about the chapter number 1 from the module C, right? I hope that you must have liked the video. And further, if you like the video, make sure as to like this video and give this video a thumbs up, and share this video among your friends and colleagues. If you want the complete PDFs and the complete course, simply just do WhatsApp CAIIB to the number 83609444207. And also, if you want to get the PDF of this session, simply just WhatsApp the CAIIB to this number, right? So that will be all. Thank you so much, and see you again in the next video.